What's interesting to me is that we have already seen SEC staff start to send comment letters to companies. They've done that this year already. Well, you were saying this sort of thing in your sustainability report. So how does that compare to the risks that you've been discussing in your 10K or your 10Q? Clearly, the staff is already thinking about, they want consistency across all those reports. And I wouldn't be surprised now to see that codified in some sort of SEC final rule about ESG disclosures.
ESG has exploded into compliance and business consciousness in 2021. Join Tom Fox, the voice of compliance, on the ESG report and learn about sustainability risks, opportunities, and issues that business leaders and compliance professionals need to know about regarding ESG.
This is Tom Fox. The ESG report is a little bit different today. It's not myself interviewing one person. I have a roundtable of folks, and we take a different look or focus depending on the person. Today, it's Matt Kelly, and he looks at the recent proposed rules from the Securities and Exchange Commission regarding climate management risk and ESG. Matt Kelly, you have looked at the ESG issue from a variety of angles, but you've been looking at it and writing about it from the SEC angle in terms of now what the SEC has proposed regarding climate risk disclosure rules. Could you tell us what those proposed rules are and what you see going forward?
Sure. So yes, at long last, we finally have a rule proposal, not an actual rule, but a proposed rule from the SEC to require climate change risk disclosures. The rule is now out for public comment for probably another 50 days or so. There's typically a 60-day comment period, and the rule was adopted, or the proposals were put out on a 3-1 vote about 10 days ago. So you have until probably mid-May, late May to sound off on what the final proposals will be. A couple of different categories of risk and data that companies would need to make under this proposal. So, for example, you would need to disclose the impact of climate-related events and any transition activities to a net zero future your company might be planning to make. You'd have to disclose those as line items in the financial statements if you had actual weather climate-related losses, like we lost 10% of our physical assets due to a hurricane in the south, or we lost 20% of our revenue generating opportunities because wildfires burned all our employees out of the home, or something to that effect. But can you tie specific financial losses to specific climate risk events? If so, put them in the 10K or the 10Q. On the annual report, you would need to make some qualitative disclosures around how does the company govern climate-related risks and what are the relevant risk management processes? Is there a committee on the board that thinks about climate risk? If so, what committee is that? And does it have any climate-related expertise? You do not need to, under the SEC proposal, you don't need to have a climate risk committee on the board. You don't need to have a climate risk expert on the board. But if you do, you have to talk about that. One thing that is also very interesting, I thought, is that if the company has a goal to transit to a net zero future, you don't need to have that transition plan, but if you do have that transition plan, you need to talk about that in the 10K. So what is that goal? How are you going to meet those targets? What's the plan? And what supporting data could you disclose year after year to show how well you're getting toward that goal? So again, wouldn't necessarily need to have a transition plan, but kind of building on what Jonathan's remarks were there, if you are telling investors and the public, look at us, we're going to be net zero by 2035, you're going to have to back that up with real data. So I think that might give some companies pause. And then the big one, the last one, is that you would need to disclose greenhouse gas emissions. Various companies would need to disclose various types. All companies would need to file or report their scope 1 emissions, what's coming out of the chimney at your factories and your properties, how much are you generating greenhouse gas emissions. All companies would need to disclose scope 2 emissions, which is how much greenhouse gas emissions are generated by the electricity you buy to heat your physical plant, to cool it off if you're down south, to keep the lights on. But whatever energy supplies you're buying, what's the greenhouse gas emissions from that? That's scope 2. And everybody would need to disclose scope 1 and 2. And then large filers and large accelerated filers, and non-accelerated filers. You would all eventually have to also disclose scope 3 emissions. How much greenhouse gas is made by your whole supply chain operation, all of your suppliers, all of the greenhouse gases that might be generated by the use of your product, and so forth. Smaller reporting companies, which I believe it's the revenue threshold of 200 million or less, I think. If somebody has the real facts and figures and I'm wrong, please let me know. But smaller reporting companies would be exempt forever from reporting scope 3. But everybody else eventually would need to report scope 3. When would we do all of this? In theory, if the SEC adopts a final rule proposal later this year, then for large filers, you would start gathering that data in 2023 to include it in the annual reports that you start publishing in 2024. So about 2 years from now is when we would start seeing all of that. And that's for the large accelerated filers. Everybody else would phase in a couple of years after that. So that's what the proposal is. There are a couple of questions that compliance officers might want to ponder here as well. So first, would greenhouse gas emission disclosures, the actual GHG numbers you're putting out, would that be subject to internal control? That's a question that Commissioner Allison Herron-Lee raised. And right now, you would disclose those numbers for greenhouse gas emissions under Regulation SK, qualitative disclosure. Should they maybe move them into Regulation SX, numerical thing like financial data? Financial data is subject to internal control over financial reporting. So Commissioner Lee asked, should we have something like internal control over climate reporting? I don't quite know how that would work. I'm not sure how, resistant a lot of companies would be, but I think that would be a jarring thing if we started having ICFR or ICCFR, internal control over climate reporting. So that's a question that she raised. Second question compliance people would need to think about is how would the audit requirement for greenhouse gas emissions work? So right now there's a question about would this be 1 year of limited assurance where an outside advisor, a climate regulatory auditor, maybe a Big Four audit firm with a climate practice, would they provide limited assurance that we don't see any big material issues here, seems fine? Or would it be the higher standard of reasonable assurance? The auditor believes that all these disclosures are correct in all material aspects. That's the standard for financial data. Should we have that higher standard of assurance for climate data? Again, not quite sure where that might land, but what will be audited and to what standard, that's going to be a big issue people will think about. Then lastly, my other concern is how would these climate disclosures you're making in the 10K, in the 10Q, how would that square with what you are putting out in those very nice, flowery corporate sustainability reports that a lot of companies have put out for years? Because you don't have to, and because nobody audits that stuff, and there's no liability attached if you're saying something incorrect. The SEC does not require sustainability reports yet. But if you have a nice transition plan and you're making all sorts of promises in the sustainability report, would you then have to make sure that that is all accurate and consistent with the 10K and the 10Q and the data you're putting in there? What's interesting to me is that we have already seen SEC staff start to send comment letters to companies. They've done that this year already. Well, you were saying this sort of thing in your sustainability report. So how does that compare to the risks that you've been discussing in your 10K or your 10Q? Clearly, the staff is already thinking about, they want consistency across all those reports. And I wouldn't be surprised now to see that codified in some sort of SEC final rule about ESG disclosures. So that's what we have going on at the SEC. I see Karen Woody. Karen, I knew you were going to bail me out. She corrects me that a smaller reporting company is that which with less than 250 million in public float. So those companies exempt from scope 3, everything else, everybody's going to be subject to. But that's what's going on. It's a big proposal, 510 pages. I don't recall seeing a rule proposal bigger than that ever from the SEC. This is a big, big, big plan.
Karen, did you have a question or comment for Matt?
Yeah, my question was about this difference in terms of whether or not you come out and say you have bigger plans for either something like net zero, and how that almost exposes a company to additional requirements. So does it incentivize companies to be quiet and to not say we're net zero or anything like that, because they now then have to follow up on that? Or what's your thought about maybe just saying less?
The cynic in me says that if we push through with this final proposal, then I kind of wonder if these sustainability reports might go the way of the dodo bird. And then a company probably would be wiser just to say, we already disclose all of our transition plans in the 10K and the 10Q. If you want information on that, here's our investor relations site. Knock yourselves out and stop there. There's no such thing as a corporate financial report, that talks about all the money that you're making. It's what's in the 10K and the 10Q, and that's it. But once the SEC starts treating these climate disclosures as something relevant to investors, I would think that a lot of companies would take a defensive posture here and just say, all we're going to do then is put it in the 10K and the Q. That's what the rules say. And if we say more, then to Karen's point, there could be some liability. So let's not, and let the 10K and Q and the disclosures there speak for themselves.
Matt, I'm going to tee up a question for you, and it may kind of lead into some of Karen's remarks. But over the years, we've had judges opine on comments companies made in their code of conduct or other ethics and compliance statements that courts have generally said are aspirational and not actionable from a securities law perspective. We've recently seen some courts begin to say that perhaps these commitments under an ESG formula, a sustainability report, or other within the 10K are actionable if a company doesn't meet them or even have a process in place to meet them. Could that be because these ESG or sustainability initiatives are viewed as material as opposed to apparently a compliance and ethics program is not material, but more aspirational? And like I said, I realize that might lead into what Karen's remarks are, but from your perspective, any thoughts on that?
I think that is an excellent question that I look forward to the fact pattern that leads to a court case where we're going to be able to discuss this in more detail. But I would say the only other point that I've wondered about with transition plans and all these promises of net zero, the other regulator that you would have to watch out for is the Federal Trade Commission. And they could hit you with a false advertising concern if you were talking about how you're so great, you're so green, and in fact, you are not making any substantive moves to that, or really you're not as green as what you're advertising. And I don't even necessarily mean great big advertising campaigns, but more what you're talking about and how you are a good green corporate citizen. The Federal Trade Commission has gone on kicks before where they've cracked down on that. I hate to say it, but it's not easy being green, but they want to make sure it's not easy just to say that you're being green. So there's that you'll have to think about as well. But once we start treating all of these promises as material and there's liability attached, you're going to have to really think about what you want to say in what circumstances if you're a corporation.
This is Tom Fox again. Thank you for listening to this episode of the ESG Report. I hope you will join us again for another episode. And I hope that if you enjoyed this episode and others, you would leave a review for us on iTunes, as it would help in our ratings. The ESG Report is a production of the Compliance Podcast Network and One Stone Creative.